Okay. We would have to put the lecture on YouTube. So for those of you who would not want your background, maybe you can turn off your video and then you will still be in the meeting, because we are going on YouTube. So in case you don't want to show your face or background, because I don't know why people are finding it difficult to join. Okay, so which of you doing something relating to corporate reporting, accounting standards? So financial reporting or corporate reporting?
I'm doing corporate reporting.
Someone was saying corporate reporting.
Yes.
Okay, who else? Any other person?
And with the standard, I think I'm not so much abreast with, is it IAS 33?
IAS 33, that is earnings per share.
Yes, sir. I'm not quite good at it.
Okay. What do you think is the problem, to be specific? Like, can you notify, is it about the, how do we call it? Basic earnings or diluted? Is there any specific session that you have problem with?
I think notional profit, is it with diluted? Yes, I think my major challenge is with the diluted earning per share.
With the diluted earnings per share. Okay. So let's discuss a couple of things there in that case. So let's start a discussion on that case. Now, for those of you who are watching the stream on YouTube, I got a signal that many of you cannot join the Zoom session or are finding it difficult to join the Zoom. So you can put your messages or your questions in the chat box. I'll be able to read and then answer for you in that case. So just put your questions in the chat box, and you can also try to join the Zoom if you would want to. Now, when it comes to IAS 33, we have the basic earnings per share and then the diluted earnings per share. Okay, Gordon, I see your hand up. Is your hand still up?
Well, no.
Okay.
Okay, I have this. I'm not confident with it.
Don't worry.
I don't know.
I've lowered.
Okay.
I'll lowered your hand, so don't worry. So when it comes to earnings per share and diluted earnings per share, it comes into it because of the way the transaction is structured. Now, what do we mean by that? You see, the basic earnings per share tells us what is happening currently in the organization. So it tells us, okay, how much current shareholders are earning with the current earnings of the organization. But there are a couple of transactions that entities undertake. And when they undertake those transactions, it ends up causing a change in the weighted average number of equity shares, as well as the profit of the organization. And that is what the diluted earnings per share is about. So with the diluted earnings per share, it's not real, but we are trying to bring the future into the present and assume that if A and B should happen, this is what the earnings of the company is going to be. So there are two broad angles from which we can look at the diluted earnings per share. Number one, when the entity issues convertible loan notes. So convertible loan notes. And then two, when the company gives share options. In these two things, there has to be a diluted earnings per share. So let's take them one after the other and then discuss them briefly. Samuel Kwesi Patrick Tinkrang said CR. Okay, do you have any questions specific in corporate reporting, Patrick? Samuel Kwesi said, please, could you touch on some of the modules in case study? Now, when you say some of the modules, which ones to be specific? Please, can I get the credentials? If you're asking credentials, I think you're talking about the meeting details, I guess. Let me see if I can just post that. Yes. Well, I'm finding it difficult to put the ID. Let me just tell you what it is. The meeting ID is 85. Let me see if I can put it in the chat. So meeting ID 825 8517 9636, and the password is 952527. So the meeting ID is available in the chat box. You can check it out. Okay, so let's look at the convertible shares. Now, convertible shares, I don't know, but it's one of the areas that cuts across a lot of the standards. It is in financial instruments, IFRS 9 or IAS 32, depending on where you are standing. But let's look at convertible loan notes in IAS 33. Now, with convertible loan notes, what happens is that these loan notes gives the stockholders the option to convert the loan notes into shares. Now, when it is time for the conversion and they convert the loan note into shares, what is going to happen is that the number of shares of the company will go up. Okay, so if the number of shares of the company will go up, that means the earnings that shareholders are having now, they won't have that earnings. So what we want to do is that even though the loan note is not yet due for conversion, and we are not even certain whether the stockholders will convert or they won't convert, all we want to look at is we are going to pretend as though they are converting the loan note today, right now. That is what results into the diluted earnings per share. So with a convertible loan note, we are going to be computing or doing a couple of computing in relation to what must be done when it comes to the loan notes, and then calculates the percentage of or the number of new shares we will get from the loan note, add it to the current shares, and then we will now be able to determine what it is in that case. If you join the stream, you mute your mic, please. Thank you. So when it comes to convertible loan notes, yes, we need to calculate the diluted earnings per share. And then that is going to be the same thing, your adjusted profit divided by the weighted average number of equity shares. But this is what you have to understand. Our profits after tax will need some adjustments, whilst our weighted average number of equity shares will also need an adjustment. Now, when we say it needs an adjustment, what do we mean? You see, with a convertible loan note, we pay interest on it, and interests are tax deductible. So if we are pretending that the loan notes are converted right now, that means, number one, we won't pay the interest again. So since we won't pay the interest again, the interest will be added back to the profit. Now, since we are not paying the interest again, it means the net or the tax effect of the interest, we will also benefit from it. So for that reason, what we do is that we are going to be subtracting the tax effect from the profit. So that is how we're going to be adjusting our profit. I'm going to be coming to that in a moment. Then the weighted average number of equity shares, like I mentioned, we are going to be looking at the number of shares that we will get on the convertible loan notes and add it to the outstanding shares, and that will give us the new weighted average number of equity shares. So let's see how the breakdown actually works. So in the adjustment of the profit, this is what happens. So we bring the profit for the year, or if you want profits attributable to equity shareholders, so we bring that. Now follow me carefully. We're going to have two cash columns. Let's bring this a little below. Two cash columns like this. So profit for the year. That will go to the second column. Then we bring the interest that we would have paid on the loan notes. That will come here. Then the tax effect of the interest will be taken out like this. And then we will get the interest net of tax, add it up to the profit for the year, and then that gives us the new profit after tax adjusted. So this is the first thing. This is the first thing. Then, so that's how we do the adjustment on this. Then how do we get the, yes, Samuel?
That's okay, that's okay.
Okay. Then we come to the weighted average number of equity shares. How do we get that? We get that by, like I said earlier, we bring our outstanding shares, then we calculate the number of shares that the stockholders will get. So weighted average number of equity shares will be equal to the outstanding shares Those who just joined, can you mute your mic for me? Thank you. Ibrahim Abubakar, can you mute your mic? You can hear me. Thank you. So we bring the outstanding shares and then we add the number of shares from the conversion. So this is how we get the weighted average number of equity shares. So let's pull a scenario up real quick to bring it, or to make it sensible in that case. Doreen, I see you. Thanks for the thumbs up in the chat. And then Samadan, I see you. You said, hello, my Ghana friend Nhyira, here from India. How are you doing, bro? Where you live in Ghana? In Ghana, I'm in Accra. I'm in Accra, the capital city. That's where I am in Ghana. Okay. So let's pull a scenario up. So let's just bring a scenario. Let's say the profit for the year, it's $200 million, okay? Then let's say the shares of the company was, let's say 20 million, okay? Then let's say there was a convertible loan note. Let's say it's a 9% convertible loan note. Let's say that was $10 million. And then let's say the tax, okay, rate for the company, it's 25%. So this is the question, simple, sweet, straight to the point. What do? Let's calculate the diluted earnings per share. Now, usually a question like this, the examiner will not ask you calculate diluted earnings per share. Now we need it. Now let me add something. So let's say the conversion policy is that you will get for every $1,000 bond, you will get, let's say 100 shares. So that's the conversion policy. Okay. So this is the question. The profit is 200 million. Shares is 20 million. The company has a 9% convertible loan note at $10 million. That's the nominal value. Tax rate is 25%. And the conversion policy is that for every $1,000 loan note, you are going to be getting 100 shares. 100 shares. So how do we calculate the earnings per share? So that's what the examiner is going to say. Calculate the earnings per share. So how do you go about that? Now, like I told you, always, even before we calculate the diluted earnings per share, we need to calculate the basic earnings per share. So what's the earnings that the shareholders will currently be having? So they will currently have 200 million over 20 million times 100. So what do we have? That should be also 200 over 20 times 100.
10.
Will that be 10? So that'll be $10 if I get you right.
That'll be
now
1,000.
usually
That'll be
yes,
1,000.
usually it should be the smallest unit of the currency. Okay.
Okay.
So let's go this way. So it should be 1,000 cents.
Yes.
So let's put it that way, 1,000 cents. So that is it. So that is the current earnings they will be making if nothing happens. But let's look at the diluted. Because of the convertible loan note, we need to tell the shareholders what is likely to happen in the future should this 9% convertible loan be converted, so that they won't have their hopes high and think they will still be making more money in that case. So that is the basic earnings. Let's go to the diluted earnings. Now, in the diluted earnings, I told you that we're going to bring our profits, 200 million, and then we will bring the interest, which is going to be 9% by 10 million. So 0.09 by 10. And that, yeah, APJ.
Yeah, Nhyira, please, the basic earning computation, won't you take into effect the tax component?
No, we have been given the profits for the year, which means
so that profit is what? Profit after tax?
Yes, profit after tax.
Oh,
usually.
Okay.
Yes. So this tax rate given to us is for us to be able to adjust the interest.
Okay.
Yeah. So Zolak said on YouTube, please like the video, share to increase engagement. Thank you, Zolak. So give us a thumbs up and then you can share the video. And if you want to join the Zoom too, you can join the Zoom so you can speak to me directly with your questions. So let's go to the converted and diluted earnings per share. So like I said, we will bring our profit 200 million, then we will bring the interest, and then we will work the tax effect on that. Then remember the conversion policy, that is $1,000 for every 100 shares. So first, let's adjust our profits and let's see what's happening. Can I, Rob? Those who are on Zoom here with me.
Yes.
Okay. So our profit is, I don't want to clean a lot, so I don't have to jump in. So let's bring our currency sign up. Anyways, I can clean this, I have it. So we bring the profit for the year, which was 200 million, put million above. Then we bring the interest. Now the interest will be 9% of the $10 million. And that will give us how much? I'm getting
0.9 million.
0.9.
Yeah.
Okay. Then we bring the tax effect of that. So tax was 25%. So we take 25% of the 0.9.
0.225.
Okay. 0.225. So we take it out. What do we have?
0.675.
Okay. 0.675. So we add that to the 200 million, and that becomes the adjusted profit after tax.
Okay.
So 200.675. Am I right?
Yeah.
So this is our adjusted profit. So once we have the adjusted profit like this, we need to now calculate the number of shares that will now be there. That is the weighted average number of shares. Now remember, the conversion policy is $1,000 for 100 shares. So let's get the number of shares on conversion first. Now remember, the nominal value of the bond is 10 million. So we divide that by $1,000 and multiply it by 100. Now the 100 we are multiplying here is 100 shares. It's very important for you to understand the clarity of it. Now, when you are punching here, you got to be careful. One is in million, one is in thousand. So you got to be careful with your punching here. So let's see the number of shares we're going to be having. 10 million by 1,000, or divided by 1,000 by 100. I'm getting 1 million. Am I right? Someone should confirm. I'm getting 1 million shares. Yes, it should be 1 million, because when we cancel 2 zeros here and do 10 over 10, it
Yes,
should be 1 million shares.
1 million.
Okay, good. So the number of shares that the bondholders or the stockholders will get will be 1 million shares. So now that we have that, we will add that back to our outstanding shares for the year to give us the weighted average number of equity shares. Let me give you some few minutes to write. Sorry, some moments to write, so we can go.
Okay, for $1,000 for 100,
Yeah.
mean you divide the 10 million
The nominal value.
Of the loan.
Yeah.
Over the, is it the conversion rate or?
Yes, we could call that the conversion rate. So every $1,000 loan will give us 100. So if we have 10 million, how many shares will we get? So that's the idea.
Okay, so 10 over 1,000 times the 100.
That's right.
Okay, okay. So the 100 are 100 shares and not 100.
Yes, 100 shares, not like currency.
Okay.
Because that is what is helping us to get the 1 million shares.
Okay.
Can we go? Everybody
Yeah.
good here?
Yeah.
Okay, so I'm interested in two things here probably. One, my adjusted profit, which is 200.675,
675.
because we would divide that by the weighted average number of equity shares. Remember, our outstanding shares is 20 million. Now we have the number of shares on conversion, 1 million. So our weighted average, please turn off your mic if you just joined, so that, or if there is a noise in your background, you turn off your mic, okay? So we avoid a lot of noise. So weighted average number of equity shares, that will become the outstanding shares, which is 10 million shares, plus, sorry. So 10 million plus the 1 million on conversion, and that will give us 11 million shares. So now our weighted average number of equity shares is 11 million. Now here you don't bring the timing ratio. Are you getting it? As to when they will bring it, or like the timing ratio doesn't come in, no bonus fraction issue comes in. You just add up straight up and go. So now our diluted.
The shares are 200. 200 million, 20 million shares.
Shares are 20 millions, not 10, eh?
Yeah, not
okay.
10.
Thank you. So it's going to be 21 million here. Okay. So our diluted earnings per share will become the adjusted profit, which I already have here, 200.675 divided by 21 million shares times $100. So the 100 here we are multiplying is $100. Okay. Because the diluted earnings per share, or the earnings per share, must be in the smallest unit of the currency. So let's work it out. Let's see what we got. 200.675 divided by 21 times 100. I'm getting 955.
0.59.
Good. Cents.
Yes.
That's it. So your basic earnings per share was, I think, 1,000 cents, if I'm right. It was 1,000 cents. So you are telling shareholders that, since here, no, you can be happy. You are making 1,000 cents, which is the same as $10 per share. But wait, when these people convert their shares, your earnings will be reducing, and that is why we call it diluted earnings per share. So that's the first side, when there is a convertible loan note. Does it make sense?
Yeah.
Okay. Then let's look at the second side, which is share option. Now, with the share option, what happens is that it's more or less, Peter Drucker calls it a golden handcuff that is literally put on the management or the employees of the organization. It is a bonus scheme that a company gives to the employees so that it will motivate them to work for the organization over a number of period of time for a given year. The idea about that is that with the share option, the employees will be buying a certain number of shares later on in the future at a fixed price today. This is what it means. If currently, today, maybe we are in 20x5, our share price, it's say $21 per share. We would tell the management that, hey, if you work for us in the next 5 years, you will be able to, everybody, buy maybe 1,000 shares. And guess what? You will buy it at just $22 per share. Now look at the deal. Currently our share is $21, but they will be buying it in 5 years' time at $22. This is the sweet spot. In 5 years' time, should they work well, our share price may be somewhere around maybe $80 per share. So the bonus component is that when they buy it at the 22, they will sell at what? 80. And so the difference becomes the bonus that they are getting for working with us. Again, how does this concern earnings per share? Because this is more or less like IFRS 2 share-based payment. But how does it concern earnings per share? It concerns earnings per share because we want to tell shareholders that, hey, listen, we've given the employees some share options. And should they exercise the share option, the number of shares will go up and your earnings will fall. So don't be happy if today you may be making an X amount of earnings as a manager, or sorry, as a shareholder. So that is the idea about share option. Now, share option has no effect on the income statement. For that reason, we don't adjust the profit. It's only convertible debt that the profit will be adjusted throughout earnings per share IAS 33. But the rest of the things, the profits will not be adjusted. The only thing that will be adjusted here is calculating the weighted average number of equity shares. So let's look at how we calculate the weighted average number of equity shares in share option or under share options. So we follow 3 steps usually to calculate it. The first thing is to calculate what is called percentage of dilution. Now the percentage of dilution is simply the current share price minus the exercise price divided by the current share price. So the share price, current, minus the exercise price. The exercise price is the price at which they are going to be buying the shares, okay? Divided by the share price. Now my space is exhausted. It should be times 100, okay? Because at the end of the day, it has to be in percentages. So it should be times 100. Once we calculate that, we come to step 2, and we calculate the number of shares in the share option. So calculate the number of shares in the share option. Now, how do we do that? The number of shares in the share option is simply going to be the percentage of dilution, which we computed in step 1, multiplied by the share option. And so once we have that, we can go to step 3 to calculate the weighted average number of equity shares. And that is going to be the outstanding shares plus the number of shares in the option from step 2. So outstanding shares plus number of shares in the option. I think for those of you watching on YouTube, my image above is covering the exercise price, but I said it, so I hope you are able to see it and write. So this is the 3-step we follow in calculating the weighted average number of equity shares. So you calculate the percentage of dilution, you calculate the number of shares in the option, and then you will now be able to calculate or compute your weighted average number of shares. So let me bring a simple illustration up so we can answer that. Let's see, should have a question here. Okay, about 17. Okay, so I'll share my screen with you with a simple question. So you can scribble down this question. Very simple, let's look at it. So profit for the year is 1.2 million. The weighted average outstanding shares, 5 million. The average fair value of one ordinary shares during the year, which is the current share price, is $4. The shares in the option is 1 million. And then the exercise price for the shares is $3. So the requirement is to calculate the earnings per share. So scribble that down real quick, then let's solve it. For those of you watching on YouTube, if you have any questions, put it in the chat box for me. This is a Q&A. So I'm currently addressing a question that someone raised on earnings per share. So if you have any questions, you put it in the chat box for me. Then for those of you who are in the meeting here with me, if you have any questions, you can raise your hand. You click on the more button, you will see raise your hand. Once you do that, I will get a signal, then I will call you so you can speak and ask any questions that you have. Can we go? Everybody done with the scribbling of this? So we are interested in almost everything here. 1.2 million, 5 million outstanding shares, $4 for the fair value of the shares or current share price. The share option is 1 million and the exercise price is $3. So let's see how we put the pieces together. So as always, even though the examiner says we should calculate the diluted earnings per share, you have to first do the basic earnings per share, okay? So if you are doing the basic earnings per share, our profit for the year was 1.2 million. And then the current share price, the current number of shares was 5 million. So let's get a basic earnings per share. So So that's 1.2 over 5 times 100. And that is going to give us how much? 1.2 over 5 times 100. I'm getting 24 cents. So that's the basic earnings per share, 24 shares, 24 cents. But we are not really interested in the 24 cents or in the basic. We want to look at the diluted. So we said we follow 3 steps. Number 1, you calculate the percentage of dilution. So our percentage of dilution is going to be the current share price, which in the question we were told was $4, divided by minus the exercise price of 3, divided by the current of 4 times 100. So let's punch that out. That's 1 over 4 by 100, that's 25%. 25%. So that's the first step. Then we go to the second step. So number of shares in the option, that's going to be 25% of 1 million because the share option was 1 million. So 25% by 1 million. And that is going to give us, I think, 250,000.
Yeah.
So 250,000 shares. So once we have that, we now calculate our weighted average number of equity shares. That's step 3. So that's going to be the outstanding shares of 5 million, not $5 million, but 5 million shares plus 250,000. And that is 0.25 million. So that will give us 5.25 million shares. So this is the weighted average number of equity shares. So these are 3 steps we go through in getting the weighted average number of equity shares. So once we have this, we can now compute our diluted earnings per share. So I'm just going to soup them above. So diluted earnings per share. Remember, our earnings will not change, so it's still 1.2 million. But now our weighted average number of equity shares is 5.25 million. So times $100. Let's see what we get now. In 22.9, maybe 23 approximately. Or we can do 22.9 cents. So that is the
22.9
basic earnings per share. Good. So you realize that this is the diluted earnings per share, sorry. You realize that in the basic, shareholders were making 24 cents per share. But now under the diluted, they are going to make 22.9. This is what we want to tell the shareholders, that currently you are earning 24 cents. You may be happy, but wait, if these guys, the management, the employees, exercise the option and buy the shares, note that our shares will go up and then earnings will be falling in that case. So that is the concept about diluted earnings per share.
All right. Thank you very much.
Okay. Any other questions for me? You can raise your hand. I'll see you there. indication. You click on the more button and then you see raise hand. So once you raise your hand, I'll get an indication here and then I'll call you up to speak and then you can ask your question. Any questions for me, please? If you are finding it difficult to join, you can watch on YouTube. No. Okay. I think I saw a comment on YouTube. Some question was saying, could you touch on some of the modules in case study? I don't know if Samuel, you are still watching. Which of the modules? There are a lot of the models. Which ones would you want me to touch on? Maybe you can clarify that in the chat, then I can touch on it. So which of the modules would you want me to touch on? Okay. So let's rub this guy. I'm seeing a chat from Desmond saying, please touch on IAS 21. And IAS 21 is what? Effect of foreign exchange transaction, I guess. Am I right? Yes, I should be.
You are right.
Yes, please.
Okay.
You're right.
All right. So when it comes to IAS 21, effect of exchange rates, what happens is that because of globalization, entities will either be buying from outside or be selling to outside. At the end of the day, how do we account for those transactions in our books as an organization? That is what IAS 21 covers. So let's look at a couple of things there that we need to understand, or some principles you need to understand. When you pick every standard or almost all the standards, you realize that we have the initial recognition, subsequent measurement, and then the disclosure requirements. So when it comes to IAS 21 also, we need to look at the initial recognition. Now the standard states that the initial recognition of the transaction should be the exchange rate at the transaction date. So I'm going to use an illustration to go through and see what we're going to be doing. So at the initial recognition, we're going to be using the exchange rates at the transaction date. That's the initial recognition at the transaction date. Then on subsequent measurement, it depends on what is happening. We can either have a financial asset, a monetary asset, and then non-monetary assets. So on the subsequent measurement of the transaction, it depends on whether we are dealing with monetary assets or monetary items, let's put it that way, as against non-monetary items. Now, when we talk about monetary items, we are referring to things such as trade receivables, trade payables. I getting it? Cash and cash equivalent. These are monetary items. But non-monetary items are assets. Okay, so tangible assets, fixed assets, or inventory. In all of those are non-monetary items. Now, for monetary items, we must carry it on subsequent measurement at the exchange rate at the reporting date in the statement of financial position. Then any loss or gain, that is forex exchange loss or gain, will be recognized in the income statement. But for non-monetary items like inventory, property, plant, and equipment, they will still be carried on subsequent measurement at the initial recognition value on the face of the statement of financial position. So let me take that again. For monetary items, you will carry it using the closing or the reporting exchange rate on the face of the statement of financial position. For that reason, they may be exchange losses or exchange gains. That is the difference between the initial recognition and then the closing or the reporting date value. That difference will either be recognized or will be a loss or a gain and will be recognized in your income statement in that case, if it is part of your trading activities as an organization. Then for the non-monetary items like inventory, those things on subsequent measurements, they will still be recognized at the initial value that we recognize them. So let's pick a question, or let me pull an illustration up, and then let's kind of find out what we can do and what we mean by these principles. So let's see. Let's pull a scenario up. So let's say A Limited, and I want you to write alongside so that we can flow together. A Limited purchases inventory on credit from Q Limited in China at $25,000. Exchange rates. Transaction dates. Maybe let's say a dollar is, now that the dollar has become something. Let's just say it's 6.25. Let's do, yeah, we can do 2 decimal place. It's actually 3 decimal, but we can do. Then the reporting date, exchange rate. Let's say a dollar now, it's gotten worse. So let's say a dollar now is 6.92. Okay, so this is the question. The requirement is, how should A Limited account for the above transaction in the financial statement for the year ended? So how would they recognize these in the financial statement for the year ended? Okay. Can we go? So we are interested in the 25,000. The exchange rate, very, very important, 6.25 at the transaction date. And then 6.92 on the reporting date. So how do we account for it? So like I said earlier, we will do initial recognition. So in the initial recognition, we translate the transaction at the transaction date. So we're going to translate $25,000 at 6.25. So let's see what we get in that. 25,000 by 6.25. And that's 156,260 Ghana cedis. So initial recognition. Remember the name of the company should always come first. A Limited, okay? So let's see value of the goods or value of inventory. That's gonna be $25,000 times 6.25. And so that gives us 156,250 Ghana cedis. So this is the initial recognition. Now, what is the double entry? The double entry for this is that, remember, we bought it on credit. So we debit the inventory. And remember, inventory is a non-monetary or is a non-monetary item. And that is debiting it with that. Then we will credit payables. Okay, TP, that's trade payables with the amount. Now, you don't do this in the exam hall. Okay, the double entry that I've done, you don't do it. I'm just illustrating it to you as to what must be done, but you don't write that in the exam hall because the examiner didn't say, even if he says journal entries, that's not what you do. You need to open the account and put them in. So this is the double entry on what we will do. That's initial recognition. So now at the reporting date, now in this question, we are assuming that the money has not been paid. Now, assuming we are repaying the money, because remember it was on credit. So when we are repaying, we will still use the exchange rate at the rate, sorry, at the date of the repayment. Okay, at the date of the repayment, and then any loss or gain will be recognized. That is the Forex exchange loss or gain will be recognized in the income statement. In this question, it is assumed that since they said we should account how the company will account for it, it means at the end of the year, the debt is still outstanding. So we still owe Q Limited 250,000 Ghana cedis or $25,000. So the question is, on subsequent measurement, what happens? So on subsequent measurement, so on the subsequent measurement, we look at the value of the trade payable at the reporting date. Remember, the inventory is a non-monetary item, so we won't change it. We will still be carrying the inventory in our books at 156,250,000 because it's a non-monetary item. But the trade payable we need to revalue it using the closing exchange rates to find out whether the debt we owe has increased due to exchange rates or reduced due to exchange rate. If the debt we owe has increased due to the exchange rate, the difference will be a forex exchange loss, and that will be recognized in the income statement as an expense. But if the debt has reduced, that will be a forex exchange gain, and that will also be recognized as an income in the statement of financial position, sorry, in the income statement. Then the value that goes to the statement of financial position is the new value that we're going to be computing or calculating in that case. Sorry, in that case. So trade payable value at the reporting date. So trade payable at reporting date, that's going to be, the exchange rate at the reporting date is now 6.92. Remember, we still owe the company $25,000. So we multiply it by 6.92, and that gives us, sorry, 25,000 times 6.92. That's 173,000 Ghana cedis. So what's happening here? You realize that the debt we owe Q Limited has gone up. So the difference leads us, so now when we go to the statement of financial position, remember, under our liabilities, current liabilities, the trade payable will be the new value we have calculated at the reporting date, that is 173,000. Then the difference between the initial value and then the reporting value will be taken to the income statement. So if you check here, you realize that we will have exchange loss because the Ghana cedi is depreciating further. So let's find out 173,000 minus 156,250, and that is 16,750,000. Sorry, 16,750 Ghana cedis. So this is an exchange loss, and this is what is taken to the income statement. So that is the initial measurement, and then the subsequent measurement, or initial recognition, and then subsequent measurement. Have we answered the question? No. The examiner said, how should these be represented in the financial statement? So we are interested in all the three values we have computed here. Inventory will be carried at, like I mentioned, the 156,250, but now our trade payable figure will be 173,000. Then in the income statement, we will take 16,750 there. Desmond, are you okay so far? This was your question, really. Is Desmond still here? Let's see. Okay.
Hello, sir. Yes, I'm okay now, but there's one other thing I would like you to help me. Mm-hmm. When the non-monetary item is measured at fair value, does it make any changes or difference in the treatment, or is just as what you've taught us now? When the
okay,
item, the non-monetary item is measured at fair value.
Okay, so assuming this is an asset, now I'm going to do the statement, financial statement, but assuming this is an asset, then remember inventory will subsequently be carried at what? In accordance with IAS 2, the law of cost or net realizable value. But assuming it's an asset, depreciation would have been calculated and probably the entity may revalue it. So when they revalue it based on IAS 16, we account for it. So once it becomes a non-monetary item, it will be accounted for based on the accounting standard, but the forex exchange thing will not affect it. But it will be accounted for now in accordance with the way it is. So if it's an inventory, on subsequent measurement, it will be accounted for in accordance with IAS 2, lower of cost or net realizable value. If it is a property, plant, and equipment, then on subsequent measurement, it will be accounted for either at the cost module or the revaluation module in accordance with IAS 16. So that is it. Does it make sense? I think your line is breaking a little bit. You said you are okay?
Hello, sir. Yes, I'm grateful. I'm okay now.
All right, thank you. So let's put it in the financial statement. Remember, all we've done is workings. We've not solved the question yet. All we've done is workings. So let's put it on the face of the financial statement, and then that's when we can tick and get our 5 marks. This is a 5-mark question that the examiner can throw at you, though. Desmond, are you doing corporate reporting or financial reporting?
Hello, sir, I'm doing financial reporting.
Okay.
I think it ends with the interpretation.
Yes, I'm asking that because if you were doing corporate reporting, like for those of you doing corporate reporting, this standard has an implication on foreign subsidiary, because if there is a foreign subsidiary, this same principle applies, and then it applies in a different way, slightly different way. That's why I was asking. So let's look at the income statement. So in the income statement, we said our exchange loss will be brought from our workings. That was the third workings. And we had 16,000. No, it's in Ghana cedis. So we're working in Ghana cedis now. 16,750. So that's the income statement. And then we come to the statement of financial position. You make sure you write it in full. Under the statement of financial position, we bring assets. Now, under assets, we're going to bring current assets, CA. Under the current assets, we will bring inventories, or just inventory. And we will use the initial value, which is workings 1. And that is 156,250. So that is it about that. Then under the, we look at the issue in relation to the liability. Now it should continue, okay? But because of my space, so I'm just dividing my space, but it should just continue. So when you're writing, it should continue. So we come to liability, and under that, we will bring current liability, and under that, we'll bring trade payables, and that will be the workings on the subsequent measurement, and that will be workings 2. And I think we had 173,000. So this is it. Remember, the workings, if you do it without extracting the financial statement, where you will not get through all the workings to be able to get the full marks in relation to that. I see some comments in the on our Zoom. Let me see. Okay, so that's one said, I'm so much grateful, sir. I honestly need your assistance. I sat in a session today for 3 hours and I didn't understand the standard. You have simplified it for me and I appreciate you. That's a pleasure, Desmond. I'm sitting for ICA for the first time in July this year and I need your assistance to be my fourth. Please help me. My number is this, okay. Desmond, you can call or WhatsApp 050-114-9296. So if you're still on the call, you can call or WhatsApp that if you have any inquiries. Let me write it here for you. So 050-114-9296. So you can reach me on WhatsApp or direct call on that number. Okay. Any other questions for me? I think Desmond had 2 standards there. The second one was IAS 7. That is cash flow statement. Wow, that would be a whole work job. So maybe another session I would explain that. Okay, because currently I don't think we have video even on really full cash flow on our YouTube channel. We have video on that on our study portal though, but on our YouTube channel, there's no video. So because that is a whole thing, I would want to discuss that in another session if that would be possible, okay? Because it's a whole standard on its own. Any other questions for me, please? Any other questions? For those of you watching on YouTube, you can put your questions in the chat box and I'll take them and explain them as well. Then if you're here on the chat, you can raise your hand by clicking on the more button and I'll be able to call you up. Then you can, yeah, this one.
Thank you very much. I'll humbly wait for the session on the topic. That's the IAS 7.
Okay.
I'll be very glad if you could help with government grants.
IAS 20.
IAS
Okay.
21.
It's 20. Government grant is 20. Is that
20,
what you're talking about?
20.
Okay. So
yes,
let's
please.
discuss
Government
that.
grants.
Okay, so let's discuss that briefly. Now, when it comes to IAS 20, it's one of the standards in the cluster of standards about non-current assets. When it comes to non-current assets, I've told you this before, and I'm referring to everyone. When it comes to non-current assets, we have IAS 16, which is the BOSS, property, plant, and equipment. Then we have IAS 20, government grants. And we have IAS 23, borrowing costs. And then the last one is IAS 40, investment property. So if you are going to be strong in IAS 16, you must make sure you understand all of these standards. There are other standards that affect IAS 16, like IAS 12, income tax, because sometimes when there is a revaluation of assets, there could be deferred tax, but I'm not going to go on that. Let me touch on the government grants from Desmond. So when it comes to government grants is simply a form of assistance that a government gives to a company for fulfilling a condition. So it's not a free money, you've got to fulfill a condition. So for instance, the government can say that any company that will go into the new created regions, now we have 16 regions, so the new created regions and establish a factory that will be able to employ 1,000 people. And of the 1,000 people you're going to employ, make sure 60% of those people are locals. Okay, they are located in that community or that district or whatever it is. And then you make sure that you are going to be selling your output to local factories. So you're not going to export. Okay, it should be to the local factories. And then so establish a company, employ at least 1,000 people, 60% of them should be the locals, sell to local, how do we call it, factories. And then Don't export anything, so no exportation. This is the condition. If you fulfill this condition, we're gonna give you $20 million. That would be sweet though in Ghana, $20 million. So that is government grant. So the question we ask ourselves is, at what point can we recognize the government grant? So the first thing you talk about is the recognition criteria, like I tell you all the time, recognition criteria. So what is the recognition criteria? Number one is that the entity will fulfill the condition attached to the grant. Very, very important. So we will, it is probable that the entity, let's write that one well. It is probable that the entity will fulfill the conditions attached to the grant. That's the first thing. That's the first thing. Second one, it is probable that the money will actually be received because sometimes governments can promise you, but the money will not come. So we should be, to some extent, certain that the money will be received. So will we fulfill? Yes, the box is tick. Number two, will the government actually give us the money? Then we take it out. Now, how can we determine if the government can actually give us the money? We have to look at precedents or what has happened in the past. So if in the past government promised a company and they didn't fulfill it, that means the promise they are giving us, we can't trust it. So if we are interested, we can go and establish the factory, but may not recognize the government's grant. But if it is certain that we're going to receive the money and we will fulfill the condition, then it's a good news. We can recognize the grants. But the question we ask ourselves also is, when it comes to grants, grants are in two forms. We have financial grants and then non-financial grants, and that is called non-financial assistance. Accounting for these are different. So let's discuss these briefly. Now, when the government provides us with non-financial assistance, that is not in monetary terms. So the standard states that we just disclose it in the footnote. So anytime there is a non-financial assistance from the government, the standard requires that we disclose. So disclosure in the notes to the financial statement. Now, what are non-financial assistance? Like for instance, government assists us so that the chief in the community will sell us the land, or government give us some people from NAPCO to work in our company. It's a form of grant. It's a non-financial assistance. We need to disclose it in our books. So when it comes to non-financial assistance, we don't have to think hard about it. All we do is we will disclose it in the footnote. Simple. But we start thinking if it is about money, so financial assistance. So let's look at that. So if it is a financial assistance, that is where the recognition criteria thing comes in, and then we go through it in that case. So when the grant is received, double entry, or when the grant is receivable, the initial recognition is what we be interested in. So initial recognition, we debit cash if the government gives us the money, or receivable if the money hasn't been received yet. Then we're going to credit the government grant. So deferred government grant account, because the government grant has to be deferred. Okay, it has to be deferred, but I'll explain an exception to this rule in a moment. So we debit we debit cash or receivable. That is cash if we have the money in our hand, or receivable if we know we're going to be receiving the money. All right. Then we credit deferred grant account. So that is the initial recognition usually. Now, before the issue about initial recognition, there are actually two ways the grants can be treated. But the first one is not something you go about. Usually, grant is about doing something. So it's always asset related. So either you are buying an asset. So the example I gave earlier was the big one, where you are building an asset or building a factory or having a business and employing people. Another time, a company can buy an asset and the government can give you a grant on it in relation to that. It can be a tax waiver. It's a form of grant. So you buy an asset and the tax on it, the government says, don't pay. It's not free money. It is called grant. You have to account for it like a grant. So tax waiver is a form of grant government gives to businesses. And there are a lot of tax waivers that the government has given. Just recently, there was a tax waiver given in the Tax Act for the automobile sector because of the deal that the president signed with, I think, VW and other automobile firms, so that they can import and they will be having some tax waiver. So when they are doing the accounting, that tax waiver is a form of grant and it will have to be accounted for in accordance with IAS 20. So initial recognition, you debit your cash and then you credit your deferred grant account. Why do we defer the grants? We defer the grants because the grants must be accounted for in accordance with the economic useful life of the asset. In other words, we account for the grant or allocate the grant over the economic useful life of the asset. Another way of treating the grant is that instead of accounting for it as a deferred grant, it could have been subtracted from the initial cash of the asset or initial cost of the asset, so that we will calculate depreciation and go our way. But that is not preferable. That is why we don't go there. So let me pull a scenario up simply, then I'll show you what I mean by that. Just a simple scenario. So let's say we buy a property, plant, and equipment, and the cost is, let's make it simple, maybe 100 million. So let's say the government says that, hey, you do well, I'm going to give you $15 million as a grant. So let's say that the economic useful life of this asset is simple for 10 years. How do we account for this in our financial statement? Simple. Like I said, there are two ways to do it. Let me do the lazy job, the lazy one, and then let's go to the standard one. Now, what I'm about to do first, you don't do it in the exam hall, because even though it's an option under the standard, that is not what is really done in practice. Now, the option under the standard is where, so first approach or first treatment, we subtract it from the cost of the asset. So how do we do that? Simple. You know, initially, what is going to happen is that we debit property, plant, and equipment with a cost of 100 million, and maybe credit cash or bank or trade payable if we have not paid for the plant yet, really. Then that is the asset. Then when it comes to the grants, we will debit our cash if government has given us the money, or receivable if it is yet to be received with the 50 million. Then we'll credit the property, plant, and equipment with the 15 million. So technically, you realize that we are reducing the PPE by 15. So right now, the PPE will be carried. So the initial cost of the PPE will be what? $85 million. That's the idea. So now, annual depreciation, I'm just going to do some clumsy job here. Forgive me. I want to have everything on the screen. So depreciation will now be 85 million over what? 10 years, the economic useful life. So that every year we will charge 8.5 million in the income statement and credit PPE. This is the first treatment. This one is in the standard, but that's not what we do in the exam hall. If the examiner asks us a question about grants, that's very important. But this is the first option. Desmond, are you okay so far?
Yes, please. Yes, please.
Okay.
Thank you.
So that's the first treatment. Like I mentioned, it's simple. Like you can see, they're very simple. You don't have to do any magical thing. You go away about that. But I'm going to tell you a limitation about this treatment in a moment. But let's look at the professional one, literally, or the right way to go. So let's get the second one. The second one is if we are accounting for it as a deferred income. All right, that's the second approach, as a deferred income. So if we are accounting for it as a deferred income, which is what the standard requires, what do? Then we don't subtract it from the PPE. We recognize the grants the way it has to be recognized. So on the initial recognition, yes, we debit property, plant, and equipment, credit cash with the cost of the property, plant, and equipment. Then we will debit cash if the grant has been received. But this time around, we don't credit PPE like we did here. Rather, we will credit what? Deferred grants. That's the difference. We'll credit deferred grants. So that is it. So at the initial recognition, PPE is still going to be 100 million. The cost, but the grant will be deferred over the economic useful life. So that is the initial measurement. Let's look at the subsequent recognition. So on subsequent recognition, our depreciation for every year, it's going to be 100 million over 10. And that's going to be, will it be 10 million? Yeah. No, 1 million. No, 10 million, sorry. So $10 million. So every year we debit the income statement, $10 million depreciation, and credit property, plant, and equipment with that. So at the end of the first year, the carrying, so at the end of the first year, the carrying value of the asset is going to be 100 million minus 10 million, and that's going to be $90 million. That is the PPE. Then the grant will also be accounted for in the same way. So what do? This is what we do. So the grant will be the annual grant charge or grant receivable. Sometimes we call it grant charge for the year. And that's going to be the 15 million divided by the economic useful life of 10 years. And that's going to be 1.5 million. Remember, grant is an income, and grant, we're going to debit the grant account to reduce it and then credit the income statement with the 1.5. So at the end of the first year, the carrying amount of the grant is going to be $15 million minus $1.5 million, and that's going to be $13.5 million. This is what goes to the statement of financial position. This 1.5 goes to the income statement on the credit side as an addition to the gross profit. Then in the carrying amount goes to the statement of financial position. But this is the sweet spot, and this is what I want you to understand. On the face of the statement of financial position, this carrying amount of 13.5 has to be splitted to the current liability. Remember, this deferred income will go under liabilities. So we must spread it into current liability and non-current liability. So how do we break it up, or how do we spread it? This is what we do. The annual grant chargeable will be the current liabilities. Then when we deduct that from the carrying amount, the balancing figure will be non-current liability. So what do I mean? So current liability, non-current liability. So under the current liability, deferred grant will be the annual grant chargeable, which is $1.5 million. Then the non-current liability will be the 13.5 minus 1.5, and that's going to be $12 million. This is it. So this is how we deal with government grants. But why is this method preferable? This method is preferable because of possible future repayment. So, because remember, every grant comes with a condition, and the government can say that if you are not able to fulfill all the conditions, you're supposed to return all the grants. Or if you are not able to fulfill all the conditions, we will prorate so that the conditions that you are not able to fulfill, you will pay for that, or you will return our money for us. So in case there is grant repayment, how would the treatment be? Let me illustrate that to you as well, like using the same example. So let's say on the 4th year, we realize that we can't finish everything. We can't fulfill all the recognition criteria. So in that case, government says, and there are two options. Government can say, let's return all the money. That's all the 50 million. So if at the end of the 4th year, let's see the carrying amount of the assets at the end of the 4th year. That will be 1.5 by 4, 6 minus 15, sorry, 15 minus 6, that will be 9. So at the end of the year 4, the carrying value of the grant will be $9 million. So let's say we are returning the whole 15 million because we are not able to fulfill the condition. Okay, since we are returning, what do? We credit our cash or bank because we are losing money, and that's $9 million. Then we debit the grant account with how much was outstanding? 9 million. And that is all. No, we are returning the whole money. I'm doing that first. So if you are returning the whole money, it's going to be, let's take that again, $15 million. We are returning the whole $15 million. Then we will debit the government grant account. Remember, at the end of the 4th year, we are having just 9 million there. So we will debit it with the 9 million to move it out. Now, there are kind of ebekohi. That's the balancing figure. So that balancing figure, it will be debited to the income statement as an expenses of $6 million. This is what happens if in case there is a repayment of the total amount. But assuming the government is generous and say, okay, if you're not able to fulfill anything, we will prorate. So at the end of the 4th year, since the government's grants available is 9 million, then probably that's what we're going to pay. So if that's what we're going to pay, in a simple language, it means that was what I was doing first. We credit our cash or bank with the 9 million because that's what we're going to return in. Let's write that out as well. 9 million, and then debit the government grant account with a 9 million to take it out. So here there will not be any income statement. So anytime we are paying more than what is available in our government grant account, the balancing figure goes to the income statement. And this is how government grants is IAS 20. That's it. Desmond, you good?
I'm good, sir. I'm good. So one last question. There are times you meet a question, the examiner will ask the entity to fulfill the conditions. The entity would be asked to pay, say, 10% of the grant. Good. So in that instance, you work 10% on the total grant amount and charge it against the government grant account, or what? How do you treat it? Like you are asked to pay 10% because you are not able to fulfill it.
Okay, so let's look at that. So let's say we are looking at the same scenario, and at the end of the 4th year, the government says, don't pay all the money, like in this case we had here, don't pay all the money, but this time around, just pay 10% like you are saying. How do we account for it? This is how you account for it. It's a double entry. Oh, well, let's go. Let's put it down. So you credit your cash. So 10% of the grant is 50 million. So 10% is 1.5. That means that's what we are paying. So we credit our cash with 1.5 million. Then we will debit the government grant account with 1.5 million. But now there is still an amount outstanding in the government grant account. So now the carrying value of the government grant will be 9 million minus the payments we made of 1.5. And that will be, is it 7.5? Yeah. So now this 7.5, we will still continue to allocate it over the economic useful life of the asset. Does it make sense? So now it means that, now it means that for the rest of the 6 years, we will be charging 7.5 over 6, and that will be the annual charge. So subsequent to the repayment, the annual charge is going to change from the 1.5 to a new figure we will be having. So now the annual charge is going to become something like this. Let's do that. So annual charge, or if you want, grant charge, grant receivable for the year. So annual charge, that's going to be $7.5 million divided by, we have 6 years left. Okay, so always is the remaining useful life. So 7.5 divided by 6, that's giving us $1.25 million. So now this is what you'll be charging every year into the income statement and subtract it from the grants of the assets in that case. So that is it. So that is it about government grants. I see a comment on YouTube from Zolak. I don't know if you're still watching. He said, "Thank you, sir. Could you do," okay. I see Musa, your hand is up. I'm coming. You will come in shortly. Zolak said, could you do a throwback on IFRS 5 held for sale? Okay, so let me touch on that real quick, then I'll come to Musa. I'm also running out of time for the day, but I'll take Musa, then we will conclude for today in that case. Or if anybody else have something, I can touch on that real quick. So when it comes to IFRS 5, asset held for sale and discontinued operation, as always, the recognition criteria. Sorry. The recognition criteria. So what's the recognition criteria? The recognition criteria for held for sale and discontinued operation. Now let me explain that. When we say asset held for sale, it simply means property, plant, and equipment that an entity is not using any longer, and so they want to get rid of it or sell it. In that case, it means that the non-current asset will be derecognized, and now we will recognize it as a current asset. So there has to be a recognition criteria. Now, discontinued operation is where a company decides to close a division, sell a subsidiary, or close a segment of a business. That is called discontinued operation. Whether it is deciding to sell an asset or held for sale or discontinued operation, the criteria is still the same. It's called the sale criteria. Sale. Now, what does that mean? Is my line breaking up? Can you guys hear me? We good? Okay, I guess it's okay. Now let's go. So the sale criteria. S simply means that management must decide to sell the assets. That is the first one. So S means sell. So management must have an intention or decide to sell the asset or to close the division or sell it off. That's the first one, sell. A means availability. So the asset or the division must be available for sale. Now, if I say I'm selling you my tablet and I'm still using it, then it's not available for sale. It doesn't meet IFRS 15 recognition criteria. So if I decide to sell it, then I should transfer all my files, all my documents, and then I will make it, I'll just put it down so that if you're ready, you come for it in that case. So it should be available for sale. L means locate a buyer. So the entity must be looking for a buyer or probably has located a buyer already. Now, how do we know this? If the entity has advertised, okay? Now, if the entity has decided to sell the asset is available for sale, but they are not looking for buyers, they are not advertising, then it does not meet the recognition criteria. Very important, very important. And then finally, we expect that the sale will be completed in less than 12 months. So expected sales to be less than 12 months. So we expect that the sales will be completed in less than 12 months. Then we can recognize. So all these four criteria must be met for us to now say, okay, something that is a non-current asset should now be recognized as a current asset. Now, on the subsequent measurement, once the item is now being recognized as a current asset, we account for it in accordance with IAS 2, inventory. So on subsequent measurement, we will test for impairment, and any reduction in the value will be recognized as an expenses in the income statement and will be carried always at lower of the cost or the net realizable value. So this is the idea about IFRS 15 held for sale. Okay, Zolak, you gave me thumbs up in the chat, so you are still here. I hope you understand what you asked. Yeah, Musa, you can come in.
Okay, sir. The last computation we did, we agreed that the government has given us the money, and later on we have to kind of pay back some part of the money.
Yeah.
I'm looking at a scenario where the government hasn't given us the money, probably so now it's under the GG receivable.
Yeah.
So let's say we're receiving it in tranches.
Now, if he has not given us the money, then he won't ask us to repay. That means he will say he won't give us the money at all.
Oh.
So in that case, it's a good question. Let's look at it. So in that case, it is in a grant receivable account.
Yes.
Hence, we need to close it up because the money will not come. So we just close it up. So let's say still at the end of the 4th year, our carrying value was 9 million and it was in a grant receivable account because we didn't receive the cash. It was in a grant receivable account. So in that case, what happens is that, okay, since the government has decided not to give us the money, maybe not because we didn't fulfill the condition or just that we won't get the money. So in that case, we just cancel everything out in the financial statement. So remember, the grant receivable will be having a debiting, it's debited already by 9 million outstanding. Okay, in our receivable, we'll still be having the 50 million, sorry, the total 50 million, because that's the initial value, okay? So we'll still be having 50 million there, and the government hasn't given us any. But in the grants, we have 9 million. So in this case, since this has happened, all we do is cancel everything and write it off. So we'll just decide to close the accounts on this. So we will debit the deferred grant account with 9 million to take it out from there in relation to that. And then we can credit. So let me clean my below lay here. So we do the treatment well. I like this question. It's quite intriguing. So we debit the government grant with a 9 million. Let's write that well. Debit government grant with a 9 million to close it. So it's not there. Then we credit the grant receivable account with 15 million to close it. It's no more there. Then the balancing figure, it's going to be 6 million, and that will be debited to the income statement as an expenses. That's it. Does it make sense?
But, yeah, it does. So in the scenario where we've received part of it, like the first scenario where we have only 9 left.
Okay. Okay. So if we receive part of it,
yes.
Okay, so if we receive part of it, that means in our grant receivable account, we are not having 50 million there. Okay, so maybe the government gave us, let's say the government gave us 6 million, or let's say he gave us 5. So now we'll be having 10 million in there. So if you are having 10 million in there, and now the money is not receivable, the 10 million, ayeka, you are changing government, like it happens in Ghana. Yes, it's a government, but ayeka. It's a government, need the Ombekas ombe or they now more holding BB and 10 million. So in that case, the same principle will happen or will appear. All we do is that we'll be crediting the grant receivable with the 10 million there to cancel it out. And I'm assuming that we still have in the deferred grant account the 9 million, so that now the balancing figure is still 1 million and will be debited to the income statement. Does it make sense?
Okay. The DG, we should be having 5 there right now. Oh.
You said?
The GG receivable. We are using receiving 10, receiving 5.
We are receiving 5. No, we've received 5. So we are now left with 10 in the GR receivable. But the GG, which is the deferred grant, we will still be recognizing the initial value, the whole amount. And written off for 4 years into account 9 million. Our account name as at the date we realize that change in government, so we can't get the money back. That's it. Because the grant receivable is not deferred. It is the government grant that is deferred and allocated over the useful life of the assets. Does it make sense?
Yeah, it does. Thanks
so
much.
All right. Okay, so that is it about grants. So we've looked at IAS 33, we've looked at IAS 21, we've looked at IAS 20, we've looked at IFRS 5. It's more or less like it's only financial reporting and corporate reporting students who are here today. So I will conclude here today for timing constraints. So I'll conclude here today on the discussion, and we'll be having a couple of these sessions to help you and address a couple of challenges that you are having. And the details will always be shared on my Instagram as well as on my Facebook page. And you can also share the notes with your colleagues. And if we announce, you can join and then you bring up your challenge. My objective is you'll be able to prepare for the May 2020 exams, which is 3 weeks from now. 3 weeks from today, you are doing final revision for financial reporting and corporate reporting. And some of you will not be sleeping, which is dangerous. You need to sleep well the day you have an exam. But I know most of you will say, Nhyira, I can't sleep, but that is it. So we'll be hosting more of these sessions. Sometimes it will be weekdays, that kind of thing. But once I schedule, look at my time, I have some time available, I'll be coming your way privately like this. We didn't want to stream on YouTube, but a lot of people were not able to join. So that's why we need to take it on YouTube. But I wanted it to just be a private meeting in that case. So that is it. Thank you very much for joining the stream. Samuel, I see Jason J, Musa, I think Desmond is gone, and then other people who joined earlier, I think after asking their questions, they also sign off. So that is it. And you take care of yourself.
Thank you.
Okay. Bye.